All right, welcome to this session once again. Samuel Ibanda, your tutor here, and we are doing a revision class for financial accounting. So today, basically, we want to look at one of the numbers that is on depreciation. This question is a question in December 2020 past paper question for CPA. Those that are doing the CPA course. So it's about depreciation, disposal, and then we also have the bank account. Now, when you get down here to the required, they want us to prepare the following ledger accounts to reflect the above transactions for the year 2017, 31st December 2019, okay? So they need us to draw up a consolidated non-current asset account. They also want a consolidated accumulated depreciation account. They also want a disposal account and then a bank account. Now, for those that you may non-current asset, of course, we know what non-current assets are. These are usually our, of course, they are our fixed assets. And then accumulated depreciation, of course, this is depreciation that relates to a given asset throughout its life, okay? Disposal account, this is where I usually call it as an asset marketplace. It's where we do the transactions of selling, okay? And then the bank extract, of course, this is just to record any transaction that affects bank or cash. So question 6 says the following information was extracted from the asset register of Super and Reliable Construction Limited, SRCL, as at 31st December 2018. So we have an asset, we have a date of purchase, then we have the cost of purchase, okay? So we have a grader, UAM 6XXL. It was purchased on 30th June 2017, and it is worth 300 million. We also have a wheel loader that was purchased like a year later, 1st June 2018, worth 255 million. Additional information, on 1st January 2019, the wheel loader, which we have here, that was bought on June 2018, veered off the road, falling into a ditch and was damaged considerably, okay? The loader was comprehensively insured. The insurance company did pay a sum of 120 million, and it was subsequently written off. On 31st March 2019, the company acquired a second-hand truck for shillings 110 million. The company has started the process of assessment for the transfer of the title, and based on the assessment, it will cost 500,000 to transfer the title in the names of the company. This amount has not yet been paid, okay? The other we have also, they are saying the grader was replaced in part exchange on 1st December 2019. The old grader was valued at 90 million. The company topped up, so this grader here was replaced in part exchange. The grader was valued at 90 million. Remember, we bought it at 300 million. Of course, it has depreciated over time. So we'll try to calculate its net book value at that time. And they're telling us that the company topped up shillings 120 million to meet the full invoice price. The following additional costs were incurred, and clearing and taxes, shillings 50 million. Freight, shillings 28 million. Then upon clearance, the company insured shillings 4 million to transport it from Kampala to a road construction site in Gulu. The company's depreciation policy is to depreciate all vehicles at 20% per annum on reducing balance method. Time apportioned depreciation changes, and then all transactions are to be passed through the company's bank account. Okay, now our required is to prepare the following ledger accounts to reflect the above transactions for their ended 2017, 31st December 2019. Okay, and they want us to do a consolidated non-current asset, then a consolidated accumulated depreciation, then a disposal account. You can see 3 marks, 6 plus 4. So you have the 20 marks right here. Okay. One of the things that I like about numbers to do with depreciation is they require less kind of time if you understand what you're basically going to do. Okay. So that is why you need to make sure that you prepare for a number like that one. So I want us to move and start our calculation. So we have the consolidated non-current asset account. Consolidated non-asset account. That is what they're interested in. I usually want to look out for the title to just make sure that my account is professional in nature. It is super unreliable construction limited. So I want to call it super unreliable consolidated non-current asset. Okay. Yeah. Okay. Don't drop the text. Consolidated. I may want to let me just try to do this. I'll put my debit here. I'll put my credit here. Since I'm doing this from the PC, I usually encourage students to make sure that you draw up the rest of the accounts as well, especially for this question. But make sure you leave enough space, okay, to make sure that you move systematically. So when I look back to the question here, what else they asked from me was the accumulated depreciation account, consolidated. Now, the reason why they say consolidated is because they don't want you to draw up an individual accumulated depreciation or asset account. They want you to draw up the same, okay? So this is the accumulated depreciation. This is non-current asset. I'll also do the one of bank. I'll do the one of bank. So myself, I'll just copy, move. Make sure you leave enough space because that account can be increased depending on the level of transactions. Okay. So I'll just move back. Just call it a bank account extract. Bank account extract. Okay, so I now have my accounts drawn up. What I also do is I'll have my working. I'll have my page for working, because this, I have a lot of workings that I'm going to do, especially around depreciation. Okay, so we'll move up. So I'm going to start now on the additional information. So whatever I read, I post accordingly. So we have this asset disc grader that was bought on 30th June 2017, and it was bought for worth 300 million. Okay, and then we have this wheel loader that was bought on this date, and it has 255. Now, one of the things that you need to take into consideration, and especially when you have such a question, let me first try to just pause a little small. Okay, so I'm saying the company's depreciation policy is to depreciate all vehicles at 20% per annum on reducing balance. And then we also have the time apportion depreciation charges as well. So reason why this is important, the time apportion depreciation charges are important, is because of these dates they have given us, the 30th June 2017 and then 1st June 2018. So you have to make sure that you take into consideration the timing factor, so that whatever you're calculating takes into consideration when the asset was actually bought. Okay, yeah. So as you can see, so we are going to now to start. So on 1st January 2019, the wheel loader veered off the road, falling into a ditch and was damaged considerably. The loader was comprehensively insured. The insurance company did paid a sum of 120 million, and it was subsequently written off. Okay, now in attempting try to reflect this within your books of accounts, yours is to first look at what was the value of the loader before it did what? It weared off. Okay, now this loader was bought on 1st June 2018, and remember these extracts were also at 31st December 2018. So what we are going to basically do for this wheel loader, we shall go ahead to depreciate it up to this period. Now, remember, it was bought on 1st June 2018, and the financial for this company is 31st December 2018. So from 1st June 2018 to the end of the year, 31st December 2018, which is also the same thing of 1st January 2019. You know, there's no difference between 1st January 2019 and 31st December. It's the same, it's just a night away, okay? So it's the same period for you to consider. So if it was bought on 1st June 2018, that means it stayed up to December, 31st December 2018. So we have about 7 months. I hope you can, because from June, July, August, September, October, November, December. Those are 7 months. So this asset, this wheel loader, lasted with us for seven months, okay? Before it did what? It veered off the road. So what we are going to do, remember they told us that it's straight line depreciation at 20%. Okay, oh, sorry, it's on reducing balance method. 20% per annum on reducing balance method. So what I'm going to basically do, I'm going to come here, say equal 20%, 20%. So I'm going to get the 255. Remember, we are first calculating it was in its first year. Now in the first year, ideally, the cost is still the net book value, okay? So even if it's straight line or reducing balance, it will be the same principle. So I'll come here. Multiply this by 255. So this is 255 million. 1, 2, 3, 1, 2, 3. Okay, like that. So I'll include it there. Then for me to get the answer to this, so 20% of the 255 million gives me that value. 20% of 255 million gives me that value. But remember, this asset, only existed for 7 months. Okay, so this is the annual depreciation. Annual depreciation for the wheel loader. So if you're getting for the 7 months, it will be 7 divided by 12 times the annual depreciation, okay, which is 29,750. You get 29,750. The 51 is the annual one. When I get 7 out of 12, I'm able to get the portion that relates to 7 months, okay, to know when this, at the time when it was disposed of, okay. Now, of course, we know very well the double entry for depreciation, that we debit depreciation with the 29,750, and then we credit accumulated depreciation 29. Okay, so this is what is supposed to be done. Now, when you look at our question critically, this question only asked us to draw up the accumulated depreciation account. So it's not interested in the depreciation account. So you're not obligated to draw it. And even if you draw it, it will just take your time. So yours is to make sure that you know how to post in the accumulated depreciation, okay? So once I come to my accounts here, definitely what I'll first do, remember we are drawing up we are preparing the ledger accounts to reflect transactions for their 2017 to 31st December 2019. I think you can see we are starting from 2017 to 31st December 2019. So what I'll basically want to do, okay, what I'll basically want to do, even before I look at the wheel loader, I'll first recognize this in the asset account. I'm going to come back to the wheel loader. So what I'm going to do, remember this wheel loader was bought on 30th June 2017, okay? So 30th June 2017, the grader is worth 300 million. So you remember when we buy an asset, we debit the asset account. So this was 30th June 2017. So we debit the asset account. Now, of course, you know very well when we are working with accounts is that we shall write bank here and then write the amount, okay? This amount is 300 million. I'll work in thousands. So I'll put a degree of precision here. Like that, okay? So this is what happened. And remember, we also have the bank account as part of the question. So I want to reflect it as well. So as you purchase this grader on 30th June 2017, the same similar transactions should appear on the credit side of our bank account, but this time it will be the name of the other asset that we bought, the grader, okay? That is what you basically record right there. Like that. So this one is also amounts in thousands. Okay. So that is what I have for that transaction. Remember, we are doing it from 2017, okay? Now, remember, their financial ends at 31st December, okay? So even before I get 2018, I have to first account for a close of 2018 or close of the financial from 30th June. Actually, this financial year, sorry, this is their financial ends at 31st December 2018. Following instruction, we extracted asset register as at 31st December 2018. Even when they got, okay. So here we're doing up 2019. So let me first close off 2017 that there's nothing that happened in the middle there within the additional information, especially in 2017. Okay. So if there's nothing that happened, then I'm going to close off my accounts before I move to 2018. So 31st December 2017, balance brought down was still 300,000. Okay, so I can have my total here. So that is my total. And then I'll have the balance. Okay, this is on 1st January 2018. This will be a balance. This is my balance brought down of 300,000. So that is in the bank account. I'll do the same. I'll still balance off my here. This is on 31st, 2017. This is a balance carried down for the same amount. I know it is tedious sometimes, the fact that you balance off an account with a single figure, but we're just trying to make sure that we follow the principles. And then it also helps you to follow through some of these years to know which year you're dealing with. So this is 1st January 2018 to have a balance brought down of 300,000. Okay, so we also, since this is 2017, we shall also have a component of depreciation. Okay, so what I'm also going to do, I'm going to have depreciation for this for grader. Remember, we are depreciating for 2017. So this grader was 300 million, and we are depreciating at 20%. Okay. When they say time apportionment, make sure that you take into consideration the number of months that this asset remain before that year end. Okay. So this asset was bought on 30th June. So it existed for 6 months, starting from July. So what I'll do 20% times the 300 million. I didn't use 300 million. Okay. 300 million. So we have 60 million. This is annual. This is the annual depreciation. But if I only want the portion of 6 months, of course, definitely I can just do 12. Okay, 6 out of 12 times what I've gotten here, my annual depreciation. Okay, so you can use that approach. This is for 6 months. So for the 6 months of 2017, I'll recognize 30 million in the accumulated depreciation account. And remember what we said, we credit our depreciation, accumulated depreciation account. So I'll take 30 million in this side. So I'll come, remember we depreciate at the end of the period. So this is at 31st December 2017. I have my depreciation, since that is the alternative account for this, and I'll recognize 30 million. Okay. Okay, let me also put a degree of precision 1,000 here. So I reduce on my value. So it should be about 30,000. Okay, like that. All right, So once we do have that, you can go ahead to balance off this as well. Since we don't have any other asset that is existing. So this is at 31st December 2017. This will be a balance carried down. So this will be 3030. And then on 1st January 2018, I'll have my balance brought down to be 30,000. Okay, like that. So I'm really done with that period 2018. Okay, so I'm now going to go and so okay, 2017, sorry. So I'm now going to look at 2018. I actually realized that all these information that has been provided here relates to 2019. Okay, so sorry. So I'll now do 2018. So at the start of the year, nothing happened. Then along the way, we bought a wheel loader, okay, on 1st June 2018. So immediately I'll recognize the purchase of the wheel loader in my asset account and also the bank account. Remember, they told us that all transactions go through the bank, okay? So 1st June 2018, we have the wheel loader coming in. The wheel loader coming in, and it is worth 255. Okay, like that. So I've recognized it here, and I also go to the bank account. I'll go to the bank account and record it. So in the bank account here, this is 255. Okay. So the double entry for that is done. 1st June 2018. Okay. Now ours is to ask, is there anything that happened before the end of the year? All this information happened in the next year, that is 2019. So what I'll do, I'll basically go ahead to balance off the account. I'll go ahead to balance off the account and also compute the depreciation for the period. So what I'll do, this side is now 555. So I'll total up, get the difference between the sides, and then I'll have the balance carried down. Okay. So on 31st December 2018, I'll have a balance carried down on this account. So in this account, I have 300 this side. And when I add up this side, what I have, the 300 and 255 gives me 555, 555, 3 zeros. Okay. So when I get the difference between this side and this side, it is actually 255. So when you add up this is 5,500. So this will be 5,500. So 1st January 2019, our balance wrote down will be the cumulative value of all the assets that are existing. Okay. Will be that. Let me just try to make these totals bold. So this will be a balance brought down here. So then if I balance of my bank account, let me account for depreciation. So remember, for this case, for the grader, this depreciation was for 2017. Was it 20? When was the grader bought? Just a moment, let me just confirm. The grader was bought in 2017, yes. So this was 2017. And for the wheel loader, this was 2018 because the wheel loader was bought in 2018. Okay. So what we are going to basically do, when you look at here, actually for the wheel loader, we've already calculated the depreciation for 2018. So we shall just calculate the depreciation for the grader for 2018. Okay. Now, before you calculate the depreciation for the wheel loader, it's good for you to know that the wheel loader, for the grader existed for the whole of 2018. As it existed only 6 months for 2017, for 2018, it existed for the whole year. So it means we shall recognize the depreciation for the whole year, okay? Yeah, but also, for you to also note that our policy is reducing balance. So what we are going to subject to, when we come here for the grader, to calculate the depreciation for 2018, what we are going to do, we shall do the 20%, multiply it by, now we should multiply this by the net book value, okay? By the net book value. And by the net book value means we are going to get the cost, which is 300 million. Okay, and then we shall less the depreciation as at before the period. Okay, the depreciation as at the end of the last period, which was 30 million. Okay, so that is what we basically do. The 300 million minus the 30 million. Now this gives us the net book value that we started with at the start of this financial period. Okay, let me just remove these commas so that Excel can compute rightly. I'll leave the formula for you so you can copy. Okay. So we are seeing that the depreciation for 2018 is 54 million. Okay, the reducing balance depreciation for the grader is at 54 million. So this is what we recognize. Remember, with debit depreciation and credit accumulated depreciation account, we don't have the depreciation account requested. So we shall go ahead to recognize the 54 as it is. Here. So this is at 31st December 2018. Depreciation, since they are now two assets, I'll even include. This is for the grader. And since it was 54 million, this will be 54,000. Okay, in case you have any question, you can use the chat box, or if you're watching a replay, you can do a follow-up question. If you're watching this from another platform, you can use the comment section as well. So that's what we have for the grader. Now, in 2018, we also realized that the wheel loader also existed. But remember, for it existed only for 6 months. And we went ahead to calculate the depreciation. We went ahead to calculate the depreciation for the it started for 7 months, sorry, because it started from when you look at it started from 1st June, okay, 1st June. So June is inclusive of the months, so that's why we use 7 months. And we had already calculated this earlier on when we started. Of course, the annual depreciation is the 20% times the 255, which gave us the 51 million. Now for the 7 months, we just made sure we did 7 out of 12 times the 51 million to get this value. So I'm going to recognize this at this time here. So at the same time, depreciation wheel loader, we have gotten 29,750, okay? 29,750. Let's write it, 29,750. 29,750 for the 7 months up to 30th December 2018, okay? Somebody says, pardon on depreciation for the grader 2018. Grader was bought in 2017. It existed only 6 months up to the end of 2017. But for the period of 2018, this grader existed for all the 12 months. Now, the depreciation policy tells us that we should depreciate all vehicles at 20% per annum on reducing balance method. So for us to calculate the depreciation for the grader in 2018, which is it's like second year, we should get 20% and multiply it by the reduced balance or the net book value or the carrying amount, okay? So at the end of 2018, the carrying amount for the grader, just repeating for somebody who just asked this, the carrying amount for the grader will be 20% times the cost minus the accumulated depreciation. Now, at the end of 2017, the accumulated depreciation, even when you look at the accumulated depreciation account, it stood at 30 million. So that is why when we came here, we got 300 million, reduced the 30 million to get the net book value, which we multiplied by 20% to come to the 54 million. So that is how we got that 54 million, which we recorded here in our books of accounts. So I hope that is clear. Okay. So That is what I wanted to stress. Now, since I'm done with the depreciation and there's no any other action there, so that is done. I'm actually going to balance it off and also balance off my bank account. So the way I'll balance it off, remember we started with 30,000, we've added this. So when you get the total, this is 113,750. So on 31st December 2018, our balance carried down will be 113,750. Balance carried down will be 113,750. 113,750. Like that. Okay. Then the total will still be the same thing. We'll get the total here and there. And then we will have on 1st January 2019, 1st January 2019, we'll have our balance brought down to be 113,750, the cumulative amount, okay? Right here, can balance off. This is 55. So the total here is 55. We can try to put it there. And then we have the same amount here. Sorry. So this is 31st December 2018. Okay, so try to balance off that. Then the balance brought down here, 1st January 2019. We just remove this here. Balance brought down. This is 55, like that. Okay, sorry. So this is 55, okay, like that. So I'm done with 2018. So I'm now going to the last year, which had most of the activities that happened. So the first is this that we have happened on 1st January 2019. The wheel loader veered off the road, falling into the ditch and was damaged considerably. The loader was comprehensively insured. The insurance company paid a sum of shillings 120 million, and it was subsequently written off. Now, one of the things that you need to know, especially when it comes to assets, either assets or inventory, is that when assets or inventory is insured and it gets an issue, we have two things. Of course, we have to file the claim, and once the claim is fully accepted by the insurance company, then we go ahead to recognize an insurance receivable. Okay, So here they are telling us that the company, of course, that did file, and since the loader was insured, they paid us a sum of 120 million. Now, one of the things that you need to know is that the advert saying it was subsequently written off. One of the things you need to know here is that ideally, this loader was the insurance company paid us 120 million, but yours should be to ask what was the net book value of this loader at this point in time. Okay. Now, well, we are going to action this. We are going to action this. Now, ours should be first to recognize what the insurance paid. Okay, what the insurance paid to us, and then also later on write off the balance. Now, just to do a small test here. Just to do a small test here. This loader was worth 22,255. Let me just try to do some small working here. So the loader was 255, okay? And for the time it had existed, it had only its accumulated depreciation. The accumulated depreciation here. Sorry, I think I deleted this column. That was there. Okay. I deleted the narration here, but just to include it. This was depreciation. This was balance brought down. This was depreciation. This was greater. This was depreciation. Wheel loader. Okay. So this wheel loader had depreciated worth 29,750 for the 6-7 months it existed before it had issues. So just want to test and see what was the value of this wheel loader for you to understand something. So this is the depreciation, accumulated depreciation for the wheel loader. So ideally, this wheel loader was still valuable at 225,250. But the insurance company only managed to give us it 120 million, 120 million. Okay, so that is what the insurance company was able to give us. So that should be able to give us an indication of something that we have to write off the balance. Okay, so ideally, given what, because the insurance company gave us 120 million, ideally the balance should be written off. The 105 should be written off. Okay. So one of the things that I'm going to do, since this wheel loader was subsequently written off, and it actually got damaged, what I'm going to do is I'm going to first transfer this to the disposal account. Okay. I'm going to write it off from the asset account because that is what exactly they did. Okay. So in writing off this asset, definitely what I'm going to do, I'm going to debit my disposal account, and then I'll credit the asset account. So that is what I'm going to basically do. Okay. So I credit the asset account because I want to write off the wheel loader. So on 1st Jan 2019, said disposal of wheel loader is worth 255. Now I'll take the whole amount because this asset will no longer be in our book. So I have to write off all of it to the disposal account. So as I credit it here, I'll go and debit it in the disposal account. Did I draw up my disposal account? Did they even ask for the disposal account? Let me just try to confirm. Okay, the disposal account is the last account. Okay. The disposal account is the last account. I think I hadn't drawn that one, so I can actually draw it. So we shall drop our disposal account and try to put in the information as we have it. That is our disposal account. It has a debit, it has a credit, and it's also in 1,000. Okay. So as I did credit it here, I'll come and debit it here. So on first this, I'll just call this wheel loader since it's within the disposal account. So on 1st January 2019, our wheel loader has been transferred to the disposal account. Okay. So in this account, this wheel loader no longer exists. So we've written it off. Now, for us, of course, to the other to do, even before we recognize the insurance return or the receivable from the insurance, let's go ahead to write off also. Every time you're disposing of an asset or you're writing off an asset, you should also make sure that you write off its accumulated depreciation. Like any accumulated depreciation that relates to this asset should be written off to the disposal account. Okay. So what I'll do here, still I'll come in this account. Remember when we are writing off the accumulated depreciation, we shall debit accumulated depreciation and credit the disposal account. Now, reason why we debit the accumulated depreciation, because accumulated depreciation has a credit balance. And so when you debit it, it means that you're reducing it, okay? So that is what we basically do. So I'll come here and say 1st January 2019, say disposal. So I'm going to write off only this 29,750 because it's the only accumulated depreciation, or it's the only depreciation that we've had for this asset, the 29,750. Okay, 29,750. So as I put it here, I'll go to the accumulated to the disposal account and credit it. So this I'll just call it accumulated depreciation. Okay. Accumulated depreciation, we load that. So I've removed it from the asset account and I've also removed it from right here. So I'll now go ahead to recognize what we received from the insurance for this asset. Now, since it was money coming in, I'll recognize it in my bank account. Insurance. Insurance recovery, or the insurance recovery, and it was worth 120 million. Okay, so as I record it here, I'll go ahead and record it in my disposal account. Reason why I recorded my disposal account, because I've now transferred this asset from the asset account and also from the accumulated depreciation. So anything to do with this asset is within its disposal, okay? Because it's also from here that I'll be able to get any profit or loss on disposal. So as I debited here, because money was coming in, I'll come and credit here in the disposal account. So on first this, still I'll use the same narration, insurance recovery on wheel loader. $120 million. Okay. Yeah. So this is what we have. Now this account is going to help us be able to, of course, balance off the amount that is going to go to be written off, okay, which is basically our loss on disposal, or yeah, written off basically. So when I try to do the two sides, of course the side is higher. The side is higher and it has 225. Sorry. Now this side, just a moment, let me just put it here. This side is lower. It has 149,750. 197,450. Let me just 149,750. We just try to get the difference. 149,750. 149,750. Okay, so the difference is 105,250. So this will be my loss on disposal or the amount to be written off. Okay, so what I'll do is I'll come here on the same date, 1st January, when it was 2019, when it was written off. I'll basically say written off amount. And then have the totals, sorry. So the totals are now the same. And I have my written off amount. So the disposal account is supposed to be fully written off. It's supposed to be fully balanced off. So for the wheel loader, that is what has happened. Okay. So remember, we already calculated this 105,250 up just from a simple man's way of understanding right here, where we said if this asset was 255 and it had depreciated 29750, then its value at that point in time was 255,250. So if insurance company was able to give us 120 million, it means that the remainder is 105,250 that is supposed to be written off, which we exactly gotten down here. So that is the same amount. So that is what I will do with the wheel loader. Okay. So I want to take into consideration the next transaction here, and then the last one, and then we go. So on 31st March 2019, the company acquired a second-hand truck. So the company acquired a second-hand truck worthy 110 million. The company has started the process of assessment for transfer of title based on assessment. They're telling us that it will cost shillings 500,000 to transfer the title in the names of the company. This amount has not yet been paid. Now, the trick here, the examiner was trying to look forward to your judgment on this 500,000 on either it can be capitalized or it's expensed. Okay. Now we have what referred to as capital expenditures. Okay. And then we have what we call revenue expenditures. Okay. So now in this case, this will be sort of this is a capital expenditure. A capital expenditure are those expenditures that are incurred in bringing an asset into operation. Of course, transfer of title, all those costs are involved in the purchase of the asset. Okay, so they are basically part of the asset. So you're supposed to include it there. Okay. Yeah. Just a moment. So this asset is worth 110 million, and the cost to transfer is 500. So we are going to include this 500 onto this 110 to make it, of course, 115. Let's just do it here. Within our working. So this is March 2019. So we have the cost of truck. It's 110. And then we have, okay, additional costs, which is the title, which is at 500,000. So that gets you to 110,500. Okay, so this is the value of the truck. So we are going to capitalize this by debiting our here. Just confirm the date. This was on 31st March 2019. It's still within the year. 31st May 2019. This is a truck. So shall capitalize the whole amount. Since we have a degree of precision, I remove 3 zeros to get it to 110,500. Okay. So what we shall also do, remember we have a bank account extract. So since this is a purchase, we shall go ahead to recognize it here as well on the credit. But this time we shall only recognize the amount that we incurred, which was 110. Remember, the 500 has not yet been paid. So this is truck 110,000. So they acquired the 110, the company started assessment for transfer. It will cost this. This amount has not yet been paid. So that is how you account for this. The examiner wanted to test your understanding. You know, every time you purchase an asset, a fixed asset, any related costs should actually be capitalized, should be added to the value of the asset. Like for example, taxes, in case you have taxes, in case you have installation costs and so on. So any cost that is incurred in bringing the asset into operation should be capitalized. Now, anything else that comes after here, for example, things like fuel, repairs and maintenance, all those should be expensed, should not be added to the value of the asset. Then let's look at this last one and account for the last one, where they are saying the grader was replaced in a part exchange on 1st December 2019. The old grader was valued at shillings 90 million. The company topped up shillings 120 million to meet the full invoice price. So it was sold before the end of the financial period, okay, which is 31st December. So the old grader was valued at 90 million. and then the company topped up. Okay. Okay, before that, somebody asks a question here. Why have I not recognized the insurance recovery? The insurance recovery is right here in the bank account, the 120 million. Okay, that is where we've recognized it there. Why have we not recognized insurance recovery in the bank account? So it is right there. I hope you've seen it, Margaret. Okay, so allow me proceed. So what we shall basically do, since the grader was replaced, ours is to first write it off from the asset account. Any disposal, either the asset is being replaced or we are buying a new okay, either we are buying a new asset or we are replacing the asset through an exchange program. We basically do the same thing. We transfer it to the disposal account. Okay. So right here, since we are disposing of the grader in the asset account, our grader, remember, the grader was
Excuse me.
Yes, please. Excuse.
Some explanation on why we have considered the cost of the truck, the value of the truck in the consolidated accumulated depreciation.
Okay, I actually realized it's supposed to be up. Sorry, it is supposed to be up. I just misposted it. It's supposed to be here. I didn't read this. I thought this was the last thing up. It's supposed to be in the asset account itself. It's supposed to be here. I was actually looking for it and I was not seeing it. It's supposed to be here. Thank you for that, seeing that. So I want to dispose of, and this was bought. Let me just confirm the date so I also correct the date. It was bought on 31st March. Okay, 31st March. Let me just try to. This is supposed to be March. Okay, so thank you. So the truck is supposed to be recognized here, not where we had put it. So we are going to dispose of the grader, which we are exchanging. So what I'll do is on this date, this is 1st December 2019. So 1st December 2019. This is disposal, and this is a grader. So we usually dispose of the assets using their original cost. Okay, so remember we bought this grader at 300,000. Okay, it is the one here, the one we bought through bank at 300,000. So we dispose it off at the same value because we are rating it off from the asset account. Okay, so we shall dispose of at that value. Then make sure that when we come to the disposal account, we debit it with the same value. Okay, right here. So using the same date, we shall go ahead to put it here as a grader. Okay, sorry, just correct this. So the grader is, we are debiting our disposal account with 300,000 and crediting here, okay? I think you can see that we have written it off from this account. So the next is to do the same thing for the accumulated depreciation, okay? So this grader, remember this grader had been around for 2 periods, okay? Part of 2017 and part of 2018. So its accumulated depreciation as at that date was over 84,000. The 30,000 plus the 54, okay? So when I'm writing off here, 31st December 2019, for my disposal, I can just call this, this was a wheel loader. And then this is a grader. So for this one, I'm writing off the total, which is 84,000. 84,000, okay? So we have 84,000. Now, as you debit it here, you have to go and credit it in the disposal account. That is how we write off our, this is the disposal account. Yes. That is how we write off our accumulated depreciation. 31st December 2019. So like that. So that's the first step you should do for any asset that you're disposing of, either by exchange, either by scrap, okay? So once you've done that, you now go ahead to recognize what exactly happened with this asset, okay? So they're saying the company topped up 120 million. Okay, first they're saying the old grader was valued at 90 million. Company topped up to meet the full invoice value. The following additional costs were incurred: clearing and taxes 50 million, flight 28 million. Okay. Then you're saying that upon clearance, the company incurred 4 million to transport it to Kampala. It from Kampala to a road construction site in Gulu. Now, here, even before we look at the old truck, ours is we want to make sure that we doing the right recognition for also the new truck that is coming on board. Okay. So since this is being valued at 90 million, what we shall basically do, we shall go in the disposal account and say part exchange, new truck, 90 million. So any payment that we are getting from the truck or any kind of exchange, it's recorded on the credit side here, okay? So still on the same day, exchange, new grader, 90,000, because they're not giving us money. If they're giving us money, still would put it here, just like the way we did for the insurance recovery for the 120 million, okay? So here they are giving us an exchange with the new grader worth 90 million. In case they are paying us cash, we'd also record it in the same place. Now, as we record it here, of course, if it was through cash, would come and debit it in our cash book here, okay? But remember, this 90 million will now be part of the new truck. So remember, on 31st, the same period, December 2019, we have the new grader. Now, this new grader is coming in different, okay, its value is a composition of course, it's a composition of the 90 million, which because in the asset account, we are recognizing the value of the asset, okay? So the part of the value of the new grader includes the old grader, which was 90 million, okay? So the first value of the new grader is the 90 million, which I'm going to recognize as the 90,000. Then I'm going to add the top up. Now, when you look at the question very well here, the company topped up 120 million to meet the full invoice value. So I'm going to top up 120 million, okay, right there. Now, the other thing that you also need to look at are additional costs that bring this asset into operation, okay? Now, we have clearing and taxes. This 50 million is supposed to be part, okay? The freight, 28 million, is also supposed to be part of the value. They are saying upon clearance, the company incurred shillings 4 million to transport it from Kampala to road construction. Now, this 4 million of transporting it to Kampala, from Kampala to road construction, is supposed, this is a revenue expenditure that is supposed to be expensed, okay? So it shouldn't be recognized. So we shall only add 50 million because this value, this one, increases the value of the asset. There are costs that are incurred in bringing the asset into operation. So this 50 million, 28 million, all should be added to the value of the asset. So when I'm coming here, I'm going to add the 50 million, which is 50,000 in this case, and I'm going to add the 28 million. So I hope you understood why I left out the 4 million. The 4 million is a cost that is incurred in the operation of the asset, okay? Remember, this is moving it from Kampala for it to go to the construction site. That is a totally unoperational cost that shouldn't be part of the value of the asset, okay? It's just like the way you buy a vehicle and it is dropped at Mombasa, and then it gets here, and then maybe you're working up country, so you drive it to up country. Now, the cost of you driving it to up country where you work is not part of the value of the cost. The value of the cost include the taxes, the clearing and freight and so on, and that will be the value of your vehicle, okay? So it's the same thing for us here. So these are the only costs that would include here. So that is why you see this 90 million that we've created on the disposal account. Its corresponding double entries is this 90 million that is composed with this new value of the grader, okay? Okay. So it gives us worthy 388 million. That is the new grade. This is the new value of the grader, okay? So that is how we would recognize the grader, okay? In 2019. So what else we should basically do is go ahead to we shall go ahead to balance off our accounts. But before that, there's something that I've tried to realize. I think we have not taken into consideration. I missed it somehow. Now, before we actually, since, and this, okay. since the grader was sold off for 2019, since the grader was sold off on 1st December 2019, we should actually also depreciate the grader up to this point in time before we dispose of the grader, okay? And that portion of disposing of the grader should also be part of our accumulated depreciation before we dispose of the grader, okay? So make sure that you do that when you're doing your question right there, okay? So that is the only thing that you need to take into consideration. And the reason why we do it is because of the depreciation policy, which says that time apportion depreciation charges. Now, you come across some questions that will tell you that the depreciation policy is we depreciate full depreciation in the year of purchase and none in the year of disposal, okay? Now, that is the alternative to time apportionment. Now, in that case, when they say depreciation is full in the year of purchase and none in the year of disposal, even if you disposed of this asset, maybe when the year was coming to the end, but if that year is the year of disposal, then you don't recognize any depreciation, okay? Now, for example, the grader here, like what we've just done is case where if the depreciation policy had been no depreciation in the year of disposal. But since the asset was sold off on 1st December 2019, and our policy says we should time apportion, then you should go ahead to time apportion this. Are we together? Okay. So it's important for us to take that into consideration. So yeah, because of time, I want to end here, but I believe you've been able to get guidance on this question. So what I will ask you, I'll ask you to retry this number on your own, and then you share with me, share on the WhatsApp group your solution, okay? So that we can be able to confirm that you've been able to follow through. So otherwise, I want to say thank you so much for being part of this. Until we meet next time. Bye-bye.